For fiscal year ending June 30, 2019, there are two GASB pronouncements. So there's GASB 83, which is certain asset retirement obligations. And then there's GASB 88, which is certain disclosures related to debt, including direct borrowings and direct placements. And then there's also an implementation guide, number 2018-1, effective. And then in fiscal year ending June 30, 2020, there's another two GASBs. So there's GASB 84, which is fiduciary activities. And then there's GASB 90, which is majority equity interests, which is an amendment of statements 14 and 61. And then there's another implementation guide, 2019-1. And then another two in fiscal year ending June 30, 2021. So there's GASB 87 leases, which I know everyone is super excited about. And there's GASB 89, which is accounting for interest costs incurred before the end of a construction period. And then there's a loaner in fiscal year ending June 30, 2022, which is GASB 91, conduit debt obligations. And this one was just issued a couple months ago, so it's fairly new, in case you haven't heard of it. So for those of you who have December 31st fiscal year end dates, this slide is for you, which has all those December 31st fiscal year end dates and then the GASBs that apply. So for fiscal year ending December 31st, 2019, it's kind of a heavy GASB year. So there's GASB 83, GASB 84, GASB 88 and 90. And then in fiscal year ending December 31st, 2020, there's GASB 87 and 89. And then in fiscal year ending December 31st, 2022, there's GASB 91. Okay, so the first one is effective in fiscal year ending June 30, 2019. And this is GASB 83, certain asset retirement obligations. You might actually hear the acronym ARO as a part of this GASB, which just stands for asset retirement obligations. But these result from the normal operations of tangible capital assets, whether they're acquired or constructed. And it can include liabilities associated with retiring those assets or disposing of and remediating those assets. So the background behind this one is that it was established because there's not much GASB guidance pertaining to capital assets other than landfills, which are still subject to GASB 18 requirements. So GASB kind of developed this to give some guidance on those other capital assets. So under this GASB, in order for an asset to fall under these requirements, there's some criteria. The biggest one is that there must be a legal obligation associated with retiring the asset, which can come from another governmental agency or by law or some sort of legal agreement. And it can also, like I said earlier, include a disposal of a replaced part. It doesn't have to include the entire asset. And it also can include environmental remediation associated with retiring that asset. And then some examples. I always think the first one's funny because I don't know of any clients that actually have nuclear power plants, but that would fall under this GASB. So that's really interesting. I don't know if anyone in this room has that, but kind of rare. And then also dismantling and removing a sewage treatment plant, or the removal and disposal of wind turbines or x-ray machines. So kind of uncommon, I think, for at least the x-ray machines like hospitals, it would apply to them. But probably most of you in this room, this GASB might not apply. But if you do encounter it, the time frame to record the liability is when it's been incurred and when it's reasonably estimable. So whether there's once there's that legal obligation to dispose of it or retire it in a certain way, it must be recognized as a liability. And so in terms of the actual accounting for it, you would book the obligation as a liability, and then it would be offset with a deferred outflow, everyone's favorite. And those two amounts will be equal to one another at inception of the, once it's incurred. And then subsequent to that initial measurement, there's going to be an adjustment for any changes. So if there's a significant change of outlays expected to dispose of the asset, then there's going to have to be an adjustment for that, which will also be booked as a deferred outflow or deferred inflow, depending on how it changed, if it increased or decreased, the future expected outlays. Oh, and I don't think I touched on this, but it's going to be expensed over the useful life of the underlying asset. And then in terms of the disclosures, so the disclosures have to have a description of the asset retirement obligation, and also the asset that the obligation relates to, and the nature and source of the obligation. So it just has to be very descriptive in that way. And also, the reason for that is so that readers can understand how it originated and why it's pretty much unavoidable that there's going to be a liability associated with it. And then the methods and assumptions used to evaluate the liability should be disclosed, and the estimated remaining useful life of the tangible capital asset would be included. And then the legal requirements should be disclosed, including how the government or the local government satisfied the legal requirements during that reporting period. So that should include facts and methods used to meet those requirements. And then finally, the assets restricted for payment of the asset retirement obligations should be disclosed if it's not otherwise apparent from the financial statements. So yeah, for this one, just in terms of preparing yourself, just keep it in mind as you go forward if you don't think it applies to you this year. And then if it comes about, just determine how you're going to deal with these kind of situations in the future and develop a process for implementing and communicating amongst different departments and such. Okay, so the next one that's effective in fiscal year ending June 30, 2019 is GASB 88, which is certain disclosures related to debt, including direct borrowings and direct placements. And so this one is just to enhance the debt-related disclosures in footnotes. And it also applies specifically to direct borrowings and direct placements because those pose a significant set of risks to local governments. There's additional disclosure items for those types of borrowings. But it does apply to all types of debt. So for the disclosures, the additional things to be disclosed are unused lines of credit, assets pledged as collateral for the debt, terms specified in debt agreements related to default, termination events, and acceleration clauses. So these things are good to start as year-end preparation comes to kind of look at the official statements and just see what other items need to be pulled out to put in the disclosures this year. So again, this GASB applies to all types of debt. However, it excludes accounts payable and leases. So I have a typo on here, which I discovered prior to today, but I think I just realized how it was set on this slide. So on your papers, you can cross out capital because it actually does apply to capital leases if they're direct borrowings. But other types of leases won't be included. Those are subject to the GASB 87 requirements, which are in the next fiscal year. But yeah, just wanted to point that out so you guys all are on the same page about capital leases. Okay, and then also in fiscal year ending June 30, 2019 is Implementation Guide 2018-1. Sorry, did I say 2018? I meant 2019. So there's 17 questions and answers. I'm not going to go into the depth of all of them, but just so you guys know, there's 9 new questions and answers. So there's a few about pension and OPEB, And then the CAFR statistical section, regulated operations and tax abatements. And then the rest of the changes are non-significant, but just wanted to point those out. And on my last slide, there's a link to, if you want to look that up too, to see specifics, if any of those topics jump out at you. Okay, so now we're moving on to fiscal year ending June 30, 2020. So the first one effective then is GASB 84, which is fiduciary activities. And this GASB was established because there's no real guidance on reporting fiduciary activities. So the thought process behind it is to provide more guidance and to also outline the different types of fiduciary activities. But basically, in order for activity to be considered fiduciary, the government must have the control of the asset of the fiduciary and also must have the control of providing the benefits to the recipients of the fiduciary. So as long as those two criteria are met, it would fall under these, or under this GASB. And then it also outlines 4 different types of fiduciary activities. So there's pension trust funds, investment trust funds, private purpose trust funds, and then other, custodial funds. And then there's separate criteria as a part of it that identifies component units and post-employment benefit arrangements that are fiduciary activities. So if there's an organization, or if you have an organization that meets component unit criteria under GASB Statement 14, the activity that might be fiduciary would fall under the fiduciary component unit guidance if it's a pension plan or an OPEB plan that's administered through a trust that meets the criteria, or assets from entities that are not part of the reporting entity that are accumulated for pensions or OPEB. So those would be considered fiduciary component units if they apply there. And then there's also non-component unit fiduciaries and other fiduciary activities. So just some extra fun guidance in there for component units. Okay, so the next one effective in fiscal year ending June 30, 2020 is GASB 90, which is majority equity interests, an amendment of GASB Statement 14 and 61. So this basically was developed to kind of apply more consistent and comparable information for reporting component units and legally separate organizations. So it's modifying the previous guidance for reporting a majority equity interest in a legally separate organization, in that the new guidance says that the government has to have 100% equity interest in that component unit. So for purposes of this GASB, an equity interest is defined as a financial interest in a legally separate organization, evidenced by the ownership of shares of the organization's stock or the measurable right to the resources of the organization. So basically there has to be that underlying right to use those resources for it to apply, for a component unit to actually be a component unit, if that makes sense. So there's 2 different types of treatment under this GASB. So there's the type of legally separate organization where it's reported as an investment. So a government can own or acquire a majority equity interest in a legally separate organization if a government's holding of that interest meets the definition of an investment under GASB 72, then it should be shown as an investment, and then it should be measured using the equity method. And then in this case, there wouldn't be any component unit reporting. It would just be the investment. And then on the flip side, there's the component unit treatment where that should also be shown as an asset of the local government or the fund that's holding that interest. And then it should also be measured using the equity method. And And then there's also some guidance in there about blended component units. So if it's a component unit, a blended component unit, the asset and the net position should be eliminated during the blending process. So this slide is more of about when a local government acquires the 100% equity interest. So in this situation, the measurement as of that date that the local government acquires the interest should be measured by using the assets, the deferred outflows, liabilities, and deferred inflows at the acquisition date. And then it should also include the net resources exchanged to get the component unit, so the money that was spent. And then subsequent to that, the flows of the component unit should only include transactions that occurred subsequent to acquisition of the equity interest. So any questions on that? Cool. Okay, and then there's another implementation guide effective in fiscal year ending June 30, 2020. So this one kind of has a hodgepodge of things. I think the biggest thing is the OPEB pieces, which are clarifying Statement 75. But then there's some about derivatives and non-exchange transactions and everything that's up there. I won't read it out unless you guys really want me to, but it's all up there. So if you're interested in that, there's also, like I said earlier, there's a link on the last slide for the implementation guides. Okay, so here's the most exciting and thrilling one that's coming down the pike. This one is GASB 87, Leases, which is effective in fiscal year ending June 30, 2021. And so this is the hot and new item that everyone's talking about these days. But basically, under the previous GASB guidance, leases were classified as either capital or operating, depending on a 4-part test, and that's under Statement 15. But what ended up happening is that a lot of lease transactions were being reported differently than similar non-lease financing transactions. And so GASB was kind of like, no, let's bring the lease requirements in line with FASB lease requirements so that the GASB and FASB is the same. So it includes all lease transactions, so operating and capital. So that determination or distinction will be eliminated. But under the new guidance, they redefine a lease in line with the FASB standards as a contract that conveys the right to use the non-financial asset for the period of time in an exchange or exchange-like transaction. So basically, there has to be that underlying right to use the asset in order for this GASB to apply. So some of the examples they provide are land, buildings, vehicles, or equipment. But each lease could be different. And the lease has to be non-cancelable, so it can't be canceled. And then some questions that have come up recently, one of them has to do with copy machines and if it would apply to copy machine leases. So technically it would apply to copy machine leases, but since those leases are very small, materiality does come into play, like any GASB. So a lot of times those leases are really small in amount and insignificant, so that's something to kind of walk the path through if it applies to you. And it wouldn't include any of the supplies, which tend to be the higher expense for the copy machine leases, like toner and paper. So that wouldn't be a part of it. And then also buildings apply, but the maintenance associated with buildings would not apply. And then some exclusions that they list are leases of intangible assets, biological assets, inventory, contracts under the definition of a service concession arrangement, or supply contracts. So an example of a supply contract would be like an agreement to purchase power or something like that, which sometimes they throw on that term lease, but it's not really a lease, it's a purchase. But just to give you an idea. Okay, so as the lessee, so you're the entity leasing the capital asset. At commencement of the lease, you would book a lease liability, and that would be offset with a lease asset. So those would be equal to one another at inception of the lease. And then as payments are being made, the lease liability will be reduced, and an expense will be booked for the lease payment. And then the intangible lease asset will be amortized over the shorter of the lease term or the useful life of the underlying asset. And then for the disclosures, those are going to be very similar to capital lease disclosure requirements. So there's really no change for that part of it. And then for the lessor side, at commencement of the lease, a lease receivable will be booked, and then it will be offset with a deferred inflow of resources. So if you've been trying to avoid deferred inflows and outflows, now's your time to shine because they're not going away. And then the underlying asset will not be retired, so that will still remain on the books and treated the same way. But then as payments are being made on the lease, the interest revenue on the lease receivable will be recognized. And then there's going to be revenue from the deferred inflows of resources over the term of the lease. And again, the underlying asset will continue to be depreciated as it normally would. And then the disclosures are going to include the minimum lease revenue and the amount of revenue received on the lease in the current year. So not too earth-shattering there. So this GASB also has other considerations for, sometimes the lease agreements can get more complex than what meets the eye, but basically for contracts that have multiple components, GASB has said that those should be treated as separate leases. So for example, if you have like a lease agreement for the purchase of like 2 police vehicles and an ambulance and a dump truck, you would have to treat each of those leases as separate leases because there are different assets involved. And then there's also some guidance on lease modifications and terminations, which I'll get into in a minute. And then there's for subleases and leaseback transactions, those should be treated as separate leases also, kind of like the contracts with multiple components. And then this, another piece of the other considerations has to do with those leases between blended component units. So if you have that type of situation, the internal leasing activity should be eliminated during that blending process. I think that would be rare, but still important to know. So for lease modifications and terminations, basically lease modifications usually result from modifications to a current lease contract, not from exercising options within the contract. So anything that changes the lease agreement is considered a lease modification unless the lessee's right to use the underlying asset decreases significantly. And then it's considered to be a termination if the lease or the underlying asset as part of the lease significantly decreases. So just some difference there. I mean, that's pretty self-explanatory, but just to define it a little bit more. So for remeasurement, so that'd be like if there was a lease modification and it changes the amount of a lease, the lease liability should be remeasured on the effective date of the modification. And then the adjustment should include the new revised amount, and then any gain or loss would be shown. And then for a termination of a lease, the lessee would reduce or remove that liability or asset from the books. And then also a gain or a loss would be recognized because it wasn't planned for that to happen. And then if the lessee purchases the asset, then it would be reclassified to an appropriate asset class. Okay, so this one, this is kind of like some ideas for preparing for GASB 87, especially because we're already in fiscal year 2020 now, this year. But it's a good idea to inventory your current lease agreements, especially because there's going to be a restatement for the beginning of the fiscal year. So it's a good time to kind of like, get everyone's attention to figure out what lease agreements exist and sort of develop a process for implementing this GASB. A good suggestion that we've been throwing around is to establish a materiality level for your leases. And a good way to do that is to use your capitalization policy thresholds, because you've already kind of gotten comfortable with those, and that would maybe be a good way to trigger treating the leases that way. So, and then some questions to ask yourself are which lease agreements would fall under this statement, and then which ones will still be in place during the implementation year, because sometimes those are short-term types of leases. And then also consider if there's any changes or questions that might come up, and figure out if there's going to be any impact to debt covenants or fund balance policies. And also develop, those things will also help you develop a system of internal controls to see if there's a way or a person that can kind of be designated to make sure that these agreements are in place and that there's all of them are incorporated. And then it will help you to encounter new agreements and treat them with your process, or if that makes sense. So any questions on GASB 87 before I go on, since it's fresh? Wow, you guys are good. Okay, so this one is kind of a baby one. This is GASB 89, which is accounting for interest costs incurred before the end of a construction period. So for under current governmental accounting standards, governments with a business type activity or enterprise fund are required to capitalize interest costs during the period of construction as a part of the cost of the capital asset. So with the application of this statement, organizations and funds should now expense the interest instead of capitalizing it. And GASB has also said to, if you are capitalizing the interest as part of your current practice, to just stop doing so. And there's no reason to restate or anything, just going forward to just stop capitalizing it. But the thought process behind this is that interest costs that are incurred are more of a financing activity instead of a capital related activity. So including it, it doesn't help add to the service capacity of that asset. So there's no reason for the interest to be capitalized. So pretty straightforward there. Okay, and then this one is GASB 91, which is conduit debt obligations. And this is basically to provide guidance on reporting conduit debt obligations and eliminate diversity, because there's always a lot of confusion, I think, with these types of debts. But under this GASB, there's 5 characteristics that must be met in order for a debt to be considered conduit. So those are that there must be 3 parties involved. So there has to be an issuer, a third-party obligor, and a debt holder or a debt trustee. And then those 3 characters cannot be part of the same reporting entity, so they have to be completely separate. And then the debt obligation cannot be a parity bond of the issuer, nor can it be cross-collateralized with other types of debt of the issuer. And the third-party obligor must be receiving all the proceeds from the debt. And the third-party obligor must be making the debt service payments. So as long as those 5 characteristics are met, that particular conduit debt would apply. And then there's some note disclosure changes for this GASB. So the note disclosure should have a general description of the debt, including the commitments, so any limited commitments, and then a general description of voluntary commitments, and additional commitments such as legal authority for extending the commitments, the length of time of the commitments, and then any arrangements, if there are any, for recovering payments from the third party, and the aggregate outstanding principal amount of all conduit debt that share those same type of commitments at the end of the reporting period. So basically just write everything you can for those debts. No, I was kidding. Okay, and then if the issuer has recognized liability, there's also separate guidance under this GASB for reporting it in the notes, just something to keep in mind. But that's pretty much it for this one.